Can high bond yields kill gold? Really crazy developments we've seen across the yield market here in the US and the metals commodity market, coming off of not so much the same news items, as yields have been moving much higher here in the US on strong economic data over the course of the last 2 years at this point. Gold, though, gold price is usually moving adversely to bond yields. Gold has also been moving higher, but obviously for a very different reason, coming from fear abroad of the war in the Middle East and what that could mean for the global economy. So we'll see how this all shakes out, but creating a very interesting environment whereby, like I say, treasury yields near 5%, and we'll do some more historical digging on that data and why that 5% number is so meaningful. And gold, it's funny, the last couple of years in gold, we've seen so many fearful events going back to the pandemic, the onset of inflation a year or so ago, and then now, of course, war in the Middle East, that $2,000 gold has become somewhat normalized. But historically, and we'll do some digging on that in a second as well, $2,000 gold is a very high price. And as we'll see in a second, very rarely do you have one, $2,000 gold, but two, a 5-year interest or a 5% interest rate, and expensive gold like that, as gold is a non-interest bearing asset, and usually high interest rates can make gold very unattractive. If I'm looking for a flight to quality, one, U.S. Treasuries is paying me 5%. Door number two, gold is paying me 0%. I'll take the 5%. But we'll get into all of that nuance in a second. I do want to do some more digging on this data and show you as much data as possible here today around this relationship, because it's a negative correlation. It hasn't even popped into green territory in the course of the last year or so. And funny enough, even with the rally in gold the last couple of weeks and the rally in interest rates that we've seen over the last couple of months, stark negative correlation as we speak, which is to say on a day-to-day basis, the negative correlation right now greater than negative 0.5, on more than half of days, they're moving in different directions, but they're both still, like I say, near highs. It really goes to show that this relationship historically is very negative. But we're just in such weird times right now where gold prices are high and yields are high. And here is some historical price data now laying on top of each other. Gold price there in black, and in blue there, the 10-year yield since 2000. And of course, right off the bat, you can see a couple of things. One, until 2020, really, one is moving up and to the right. The other is moving down and to the right. As interest rates, remember, until the pandemic, and pandemic again brought interest rates down near zero, the 10-year rate was going from the late 90s being around 6 or 7% to the mid-aughts being around 4 or 5%, to the 2010s being around 3 to 4%. And then, like I say, at the pandemic, some of the lowest 10-year interest rates in the history of treasuries in that same time. Gold is going from a triple-digit product to $1,000 plus product to one that got up to $1,900 around the 2010s, and then settled in around, remember, we traded between 1,200 and 1,600 in gold for a while in the 2010s. The pandemic hits, interest rates go to 0% essentially, and gold hits $2,000 for the first time in, I don't have data for it, going back at least the last 20 years or so. So you see that relationship broadly playing out, but then you look to the most recent couple of months, and it's like, man, gold, it's not above $2,000 right now. It's not at its highest prices ever, but it's pretty close, man. And interest rates are back to around 5%. And the last time interest rates were around 5%, gold was a fraction of this price, was essentially around half of this price. So really interesting to see that historical piece. And now you've got all the data there. Here's a little bit of theory around what we're seeing right now in terms of weirdness and what we could see in the future in terms of normalization, because this can go a couple of ways. This doesn't have to necessarily be, rates are high. The Fed says they're going to be high for the foreseeable future. And so they'll stay high and gold will move lower, because fear can continue to build. That's why we're in this strange situation, is we have a strong U.S. economy, but we also have rising risks abroad that are causing this coincidence of high fear, but also a strong stock market, strong economic data, strong economy in general. And so fear can continue to build, and it can bleed over into the U.S. economy. And you can see the Fed have to move interest rates lower because of this building fear, like they did during the pandemic. And in that case, you would theoretically see an unchanged to higher gold market. On the flip side of that, the instance where interest rates do, as we say, kill gold prices here is if fear reverses, it's short term, they're able to work out the situation in the Middle East. China and the Euro area are able to see that soft landing, pick their economies back up a little bit here. You might see yields stay higher for longer, maybe move a little bit higher, and gold prices subside with that fear. Of course, these are all theoretical. And of course, both these markets could back off from their historical highs. Both these markets could stay near their highs forever. It's just, given historical movement and those correlations that we went through and everything else, it's not been historically sustainable, I would say, for high interest rates to coincide with high gold prices. That being said, no guarantee either to the reversion of one or both moving off of these highs, or two, to the timing. This is the really tough piece, right? Because if you ever pairs traded before or traded based on correlations, you see that this is a stark negative correlation. These markets are both high right now. You think interest rates will stay high, so you short gold, or you think gold prices will stay high, so you short interest rates. Time is a huge component of this, because these prices can be, quote, out of whack for however long they'd like. And I'll show you, sticking in the interest rate realm, the yield curve in the US has been out of whack for more than a year now. This is that 10-year rate, even with the run that it's been on over the course of the last several weeks, still inverted, still an abnormal yield curve. And it's been this way since summer of 2022. We're almost a year and a half into this inversion, and it's normalized a good bit over the course of the last several weeks. Like I say, it's gone from an inversion of negative 100 basis points to negative right now around 30, 40 basis points. But still inverted. This is another case of, an abnormal relationship that we see in the markets, and maybe it will normalize to a normal yield curve. But is that going to be next week, next month, next year? We'll see. So yeah, right now, very strange to be seeing bond yields at historical highs for the last 15 years. Gold prices near those historical highs that they've traded around for the last several decades. One could thwart the other. Timing will be interesting, and it'll be interesting to see which one wins.